The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to today's webinar on what every startup should know to avoid financing pitfalls. So this webinar today is part of our university startup development webinar series, and I'd like to thank our audience today for joining us this afternoon. Just a reminder that we do have some upcoming webinars under this series. So on November 29th, we have a webinar on term sheets, and on December 6th, a webinar on building a management and leadership team and a board of directors and advisors. So we'll be sending out announcements about these webinars, and hopefully you and your colleagues can join us then. There will be Q&A at the end. So if you look at the GoToWebinar control panel on the right, you should see a questions box where you could type in your questions. So as I said, Q&A will be held after the lecture concludes. When you type in your questions, we'll be able to tackle them at the end. So hopefully we'll get through as many questions as we can, and hopefully we get to answer, those questions that you post on the control panel. As you know, the slides and video of this webinar will be made available 24 to 48 hours after the webinar concludes. There are a couple of links here that we'll post on the chat box of your GoToWebinar control panel, and they will be sent to you also via email after the webinar concludes. So this webinar series is being held in order for you to know more about the Startup Development Program and how to engage with NCET2 and our Startup Development Officers. So if you're a university with IP or startups and you'd like to engage with us and see if your IP or your startup is a good candidate for the Startup Development Program, email us at startupdevelopment@ncet2.org so we can send you a copy of the sample application forms so you can start preparing for the information so you're prepared as to when we open the application later this year. Or if you're an ex-corporate, a serial entrepreneur, or an angel investor, and you'd like to be part of our Startup Development Officer team, send us a copy of your CV along with a short note in an email, and email that as well to startupdevelopment@ncet2.org. And if you fall into any of the categories, we'll get in touch with you and schedule a call. So hopefully these two items would be, good areas for our audience to engage with us, and hopefully we hear from you. So now we come to the main event. We have two speakers today. Our Director of Business Development and Alliances, Dr. Glenn Vonk, will be talking a little bit more about the Startup Development Program. Then Kenneth Polk, he's one of our Startup Development Officers, as well as the Council of the American Chemical Society. We'll talk about the pitfalls in financing. So hopefully, everyone in the audience will be able to join us for the entire session. So Glenn, I'll turn it over to you now to talk about the background of the program.
Okay, thanks, Ria. For those of you that have heard this before, I promise I'll get through this in just a few minutes and we'll get to the real part of the program with Ken. And for those of you that haven't heard this before, you may have questions and there will be an opportunity to ask them at the end of the program. So Ria, if I could have the first slide. So this shows a timeline of describing really some of the history that I've had with NCET2 in development of commercialization model that we operate from. That began in early 2015 with Congress approaching NCET2 and asking for more definition about how technologies that live in universities are commercialized. And we went around the country talking to different universities and startups and investors, developed that model towards the last part of 2015, went back to Congress, talked to them about it, And from that developed a concept called a demo day, which was a way to efficiently evaluate startups in the context of what corporates thought about them, helping corporates efficiently connect with them. In those demo days were very productive. All of the parties saw a lot of value in them, and we've continued to move them forward. Part of that also was realizing that there was intellectual property in the universities that was potentially commercializable, and corporates telling us that they were really looking for more aligned startups that could advance their strategies. So we began the IP to Startup program as a way of doing a similar activity where we had linked startups to corporates. We're also working on bringing IP to corporates and then helping package that in startups and move that towards commercialization. So that's the sort of the big picture of what we're talking about today. Next one, please. So this is the model that came out of our research across the country with the different stakeholders, talking about $137 billion in R&D investment in the public sector, plus corporate R&D that's outbound. That being packaged into startups, often living in universities where we find that startups are 6 times more likely to succeed in it with the university infrastructure than when they don't have access to it. Those startups can be connected to corporate interests and investors through the Corporate Commercialization Council, RCCC as we call it. That supplies gap funding that can move them towards private investment or stand up in the IPO. So next slide, please. Again, $137 billion is what we're leveraging. And this is an opportunity for the researchers that have done the work to connect with entrepreneurs to build a startup around that investment. The corporate members also participate in helping to direct the best path forward for those startups. Next slide, please. The startup development officers are typically ex-corporates or entrepreneurs that we have connected with in our network that can come alongside of the startups and work with them in commercialization. So what we found in our research is that startups, once they're created in the gap, often lack management talent, and corporates don't have an unlimited resource to be able to direct them and support them in that early phase development. So the Startup Development Officer Network is a way to provide that resource to the startups and accelerate their progress towards commercialization. Next slide, please. So the benefits, the things they actually do are shown here, from business plan to funding. We like to talk about commercialization experiments where one can quickly create a startup and work on commercializing the intellectual property from that startup, finding an appropriate venue for that, and moving quickly towards an actionable decision for that particular invention or intellectual property. Next slide, please. So the benefits, again, for the startups, entrepreneurs, faculty and researchers and students are access to talent to create and develop and fund. For universities, they can move their intellectual property towards significant market events. And we also like to work with students. We had actually a student startup at our demo day, and it was a very good startup. And we believe that students can be effective managers with and leaders within their startups with the right kind of support from the startup development officer. So this is a whole opportunity to provide an educational resource to the universities and their students. Next slide, please. So to engage, again, submit your intellectual property, our startups to NSET2, and you can do that either at the website or by emailing us. And if you are an entrepreneur, an ex-corporate like myself, you can become a startup development officer using the contact information shown here on the slide here. So we'd be excited to work with you. Next slide, please. Now it's my privilege to introduce Ken. Ken is an NSET2 Startup Development Officer and Senior Counsel and Innovation Strategist for the American Chemical Society. Before joining ACS, he practiced intellectual property and business transactions law at the world-renowned firm of Reed Smith, as well as environmental law with the Pittsburgh boutique firm of Batts Collin. For nearly 12 years, Ken founded and maintained a law practice directed at counseling small businesses, entrepreneurs, early-stage startups, and legal matters pertaining to IP identification and protection, private equity, acquisitions, enterprise formation and development, and technology licensing. Ken worked with the University of Pittsburgh as its research council program liaison officer in establishing its first industry outreach office for the marketing, negotiation, closing of unique technology transfer arrangements. And we have had very good relationship at NSET2 with the University of Pittsburgh. Ken has also acted in various capacities for startups, including executive level positions in business development, legal, and operations, raising nearly $10 million in seed funding. Ken, my privilege to turn this over to you and hear what you have to tell our group. Thank you.
Hey, Glenn, thank you very much for that. I really appreciate that introduction. And I want to say hello to everyone and thank you for being with us today. It's a great pleasure to hold this webinar, and I hope it's helpful for you. I think at the outset we have to say the financing a startup is a very complicated process, and it's fraught with pitfalls. And I'm sorry to sound so negative, but there are many, many pitfalls, but there is a great deal of elation after you raise your first round of money from investors who are private investors. And so sometimes the rewards are well exceed the price that you're paying in time and energies. I don't want you to come away from this webinar thinking that I pretend that I know everything about this subject, because I have to tell you the process is very complicated. And what I'm about to present has many, many more aspects to it than this, but I chose these because these may not be necessarily the most obvious ones to speak about, and hopefully that will give you a deeper level of insight when you're fundraising. So that's my hope for you today. So Glenn talked a little bit about this, and I don't think there's anything I could possibly add to what he talked about with the program. I'm very delighted to be part of the program. And I think the most important thing is, as a startup development officer, I'm very interested in assisting early management teams with their most pressing early needs. There's a lot of heavy lifting in the very beginning. It has to do with your business planning. No matter what the approach you take, whether it's the old business plan approach or the business model canvas, there's a lot of aspects to bringing a startup together. One of those aspects is financing, and that's kind of what we're going to talk about today. So I think you ought to just have a little relevancy as to why I'm kind of doing this talk, and so hopefully this helps you a little bit. I've got about 25 years of experience as an attorney this year. In fact, it's now my 29th year of being a lawyer, so I'm very happy about that. I've been in the trenches with many of you. I have to say I've served in the executive capacities with startups and small businesses, and I've seen a lot of technologies and been involved with a lot of deal making, and it's been a very exciting career thus far. I possess somewhat of a unique kind of perspective. I have a strong technical background, a very strong legal and business experience background. I will share with you, I was crazy enough to sit for the professional engineer and bar exams in the same year. That's a little bit crazy, so don't try that at home. But I'm very proud to say that many, many moons ago, I was able to achieve that. And now I am an integral player for ACS in its business and program efforts to advance towards serving the public. So let's start. Let's just say, fundraising is like landing a plane. Bigger runways are needed for larger planes. And you're probably wondering, okay, Ken, what might that all be about? I will say to you, the beginning starts with the end. So let's start with that end. What is your end game? Are you the next Apple? Is that what you're thinking? Or would you like to exit to a corporate by feeding into their product pipelines? You need to think about this. You need to find out what is your success. How do you declare yourself a success? Because financing your company is going to depend on that decision. For this talk, we're going to say that financing involves OPM. I don't know if you ever heard the concept OPM. It's other people's money. It is not a grant funded or grant sourced of funding. It's not provided by the NSF or the NIH. It's not provided by venture capitalists per se, but it's more or less by individuals who are termed angels because they're accredited investors, as that term is defined by the Securities and Exchange Commission. So we're going to just broadly say OPM, other people's money. And what you want to know is, despite what you might believe, there actually is a finite amount available to you, and none if your value proposition isn't compelling. So unlike an excellent grant to, say, the NSF or NIH for SBIR funding, you're not entitled to a private individual's fund to fund your dream. And you should not raise money more than you need, and I'll kind of explain that to you a little bit later. So let's start first by saying we all have grandiose ideas of what the company could be, and that everybody is going to provide us with lots and lots of money, and all we have to do is request it. And I'm asking you, please, to avoid wishful thinking. And this is kind of where we're coming from. So from a lawyer's perspective, I have to say to you, no one actually owes you a duty of candor unless you're under agreement. So when you're having chats with investors and they tell you this is very interesting and I think this really can go somewhere, that actually means nothing. Investors can be opaque. They are opaque. They're opaque by design, and they have very good reasons to be opaque. It's difficult to read them because they're not sure about you. They're not sure about the risk that they're going to be embarking upon, and they definitely do not want to signal something that they shouldn't be signaling. You need to know there is a tug of war for their money. Perhaps other startups are vying for their investments. The question for them is their money well placed with you? And this begins with whether you are trustworthy, and it really is a big deal. I remember an occasion where we were raising money, and I talked to an investor who only wanted to talk to me, came to me, and we sat down and had lunch at a small restaurant. And he told me, gee, Ken, I wish you would have been the CEO. I can't invest in the company. Of course, I sloughed off that, and I said, can you just tell me why? And he says, you know, I looked the guy in the eyes, and I don't trust him. And we lost over $1 million investment. So trustworthiness is very important, because at some point, these individual investors are going to need to know that you say what you mean and you mean what you say. So sometimes the opaqueness of the investors, and it seems like they're a little bit more elusive relative to the words that they say. And you're a founder, and you can be a little bit put off by this, and that's perfectly understandable. You shouldn't be put off. You should consider that this is about business, and this is about the ROI, return on investment, and it's not personal. It's something that you will have to grow a thicker skin to begin to know how to take no's, plenty of no's, some no's that you really don't want to hear, some no's that you wish you hadn't been around, or at least you'll begin to think, why did I even talk to that person? But every single conversation is a learning experience. There's always a takeaway. There's always another arrow in your quill so that you know next time what not to do, what you could do, what you shouldn't do, and how to get better and better at it. Have a time frame. I think this is really important, because when you're talking to a lot of people, people tell you, yeah, contact me next month, contact me at the end of the year. You really have to have a time frame, particularly for when you're going to conclude discussions. And I'm talking a little bit outside of the slides, so I hope you can understand. I know you can read and you can look at my slides, but I also want to give you some more depth. So a lot of times we don't have time frames for concluding discussions. If they don't hold true on the time frame, you're risking chasing people for a long period of time. And that's money money kind of will seek its own level. You'll know soon enough about whether a company is positioned for the investment or not. But as Don Quixote was chasing windmills, there's a lot of that goes on too. That is all a learning experience. That is not failure. That is honing and fine-tuning your messaging with the hopes that you'll find the right person that wants to hear that message. So the next point I'd like to tell you about is sort of don't raise money until it wants you. Okay, Ken, what are you thinking about this? That sounds confusing. It sounds like, I've got a great technology. Everyone wants to give me money. Well, that's not true. And raising money is not about some sort of a valuation fight or a valuation argument. Like my company's worth 10 million. No, it's worth 5 million. No, raising money until it wants you means that money is ready to help you grow. And let's talk for a minute about that. So high valuations ordinarily lead to great dashed expectations. So a high valuation for a startup is anywhere in excess of $2 or $3 million, maybe $5 million. I've heard people say, Ken, I'm worth $16, $20 million. And I've said, great, go find someone that thinks the same and you're in business. It's not going to be me. So you have to be realistic, and it's really not about the valuation. It's really about rapid growth. Do you have an opportunity to rapidly grow? Do you have an opportunity to raise a lot of funds through revenue, through customer adoption? That's really where you're going to see a higher valuation. So revenues support high valuations and low percentage equity placements. When you're bringing in revenue, your valuation goes up, your equity placement goes down, and you can get a lot more money for 10% when you have revenue than if you were offering 10% with no revenue. So you may be giving out 15 or 20% with no revenue, whereas you may only be giving out 10% with revenue. So that's what I'm talking about when I say that the valuation shouldn't be your benchmarker. The valuation is really about just one piece. It's really about rapid growth. Position your startup to demonstrate the potential for rapid growth. There are times when you're not ready to raise other people's money. Typically, this occurs when you have really nothing to show. It goes back to the old days. I guess I'm kind of old, but we used to have show and tell. So when you're able to show something and tell about a product that helps solve a solution and customer adoption comes, now you've really turned the point. So building out management teams can be viewed as wasting money. So you have to be careful about what how you're going to use money. And customers buy products; they don't buy business development executives. And Glenn, I apologize to you in advance for that, but I think you get the gist of this. It's the management team's important, but customer adoption is more important, and customer payment is even more important. So waiting for more revenue can have a disproportionate increase for your valuation. And there's really no substitute for customer validation. If other people's money doesn't help you grow rapidly, then maybe it's better to wait. Okay, so fundraising is distracting. Be all in or not at all. And I can tell you over the years that I have raised money. I think this is one that kind of really strikes at my heart. Fundraising is very time consuming, it's very frustrating, and it's document heavy. So first of all, prepare a summary of the potential arrangement, not an offering, just a potential arrangement. This is kind of like things we think we're thinking, but ensure that it is not as concrete as an offer until you're ready to do that. There are many areas deserving of your time and attention, and you can probably draw to 5 or 10 of those aside from fundraising. So my strong advice is that you stick to a 3 to 6 month window for concluding a round. That involves identifying your target accredited investors, having discussions with them, engaging in non-disclosure agreements, possibly engaging in some due diligence if they want, and try to conclude a term sheet with them within that time frame. The time frame can slip, but I think between 3 and 6 months, you're going to find out who's really interested and who's just talking talk and not walking walk. If you cannot conclude a race within this kind of time frame, or you're not getting serious bites, NDAs, or maybe due diligence requests, then perhaps you're really not ready. And we're going to talk a little bit about that a little bit later. So a startup development officer is ordinarily knowledgeable enough on the first round effort to advise you on whether to raise funds. And I think this is what's very unique about the development program that NCET2 and Tony has put together, and Glenn is intimately involved with. These are very seasoned people that can help you in one way, shape, or form relative to your business planning and even your financing, and I'm hoping this is somewhat helpful to you even now. But startup development officers bring that experience with them, and that there's no substitute for that. That can shortcut a lot of time, a lot of energy, and save money. You being a great guy and a gal, you know, I got to tell you, I can't tell you how many people said, gee, you're a really nice, likable guy, Ken, but no. It doesn't carry any water. It doesn't carry the day. So what? So you are a nice person. That's great. People love that, but they won't invest because of that. So bear that in mind. You need to have a very strong overall business value proposition with rapid growth potential, and revenue is even better. Okay, so you also need to know that, you know, if I have $100,000 in my pocket, I might put that into another resource. So there's a competitive nature to raising capital that you have to kind of be mindful of. So I'll rhetorically ask you sort of, how do you invest your own money? I mean, do you hand it to startups that are just getting started out of their garage and with the hopes they'll be the next Apple? You know, probably not. And actually, I doubt many, if not all of you listening, are somewhat or greatly in the market. If you have sort of a 401k or a retirement, you're in the market. So you're already placing your bets with the marketplace instead of placing your bets with Ken Polk, who started his business out of the garage. Now, conversely, you're not going to get 5 or 10x returns by being in the market. So that's part of the reward that comes with the risk. Remember that many of the investors you are speaking with are also in the market. So that is an option for their money. They don't have to invest with you or any startup for that matter. They do so primarily because they are they're able to absorb the loss in a highly risky investment in a way that most people aren't. But their hope is the return that they will get with you couldn't possibly be matched in the marketplace. So that's sort of the quid pro quo, right? The big upside, you know, kind of warrants the risky investment, but they do have options, and you do need to remember that. Don't be surprised if an investor wants to hedge their bet on you. This is typically done through a board seat or a management implant. You know, they might show up for coffee too. Let them make coffee and let them help you with the coffee, but they're also going to want to know as much information as you're willing to share. So you want to be cognizant of the fact that it is not unusual for an investor to want a board seat. It is not unusual for an investor to want to have a consultant or someone who's observing the company to ensure that you are doing what you told them you would do with their money. Now, typically to, you know, board people and also management implants, that can be somewhat of a problem for your process because it always seems a little bit like people are looking over your shoulder. And we'll talk about that a little bit in investor management, which is another big possibility for a pitfall. At the end of the day, if you remember me for nothing, you'll remember me for this. It's all about the ROI. To investors, your technology might be wonderful. It's about the ROI. To investors, the management team might be superb. It's all about the ROI. You'll get a repeat investment if you can give them an excellent exit and they can turn around and put it back into something else that you're doing. It's, again, all about the return on investment. And it's not just the return on investment, I mean, in the context of how much, but it's also in the context of the time horizon. Ordinarily, some investors will think 2 years is too long. Maybe 2 to 3 years, they'll give you some latitude. 5 years, forget about it. 10 years, they hope they're all alive by the time you succeed. So I think you need to think about the magnitude, how much you're going to ask, the expectations on the return, the expectations on what are some of the anticipated events that you are counting on to help deliver that return. And then you also have to think about what could go wrong. So if you do a little homework, and I can give you a little bit of homework, please look at a 10K report of a publicly reporting company. You can find these on the EDGAR system of the SEC. And in those 10K reports, those reports come out by the chief executive officer in much the same way. Here's what we're doing. We're doing really well. All of this can be upset if this happens. All of this can accelerate exuberantly if something else happens. That's the kind of conversation you want to have. Okay, so we talked a little bit about this. Valuation is not a true measure of value, revenue is, and I think that's a little bit more, it might be a little bit of a new concept for you. I want to tell you, don't get caught up in the valuation game, all right? It seems like founders like to talk to each other and focus on the number. I had a couple investments that we were looking at ACS, and people were talking about, oh, we're, people close $16 million investments, and I heard somebody else, spent 20 million. Well, that's all well and good. Again, if you can find somebody like that, that's great. Congratulations. To me, it's like getting a good grade, right? You have the potential. Your valuation is like getting a good grade, all right? I get all A's. That doesn't mean that's going to translate in the workplace, and that doesn't mean you're going to be productive in the workplace, and that doesn't mean you're going to have a successful career. So it's a starting point. It's helpful, but shouldn't be what you want. What you want is revenue from a customer. So revenue is customer validation. New customer revenue is good. Repeat customer revenue is better. Accelerating customer revenues is best. It's all about the customer. And I'd like you to, people can get new customers, but repeat customers are fabulous. That tells you what you are providing is absolutely meeting the needs of the people. They're coming back again, and they're paying more. So that's validation. Don't forget to, I know we're all very technical, technology is good, cutting edge technology is better, but a compelling overall value proposition is best. Cutting edge technology, great valuation, great team, a very capable, experienced team, very good market position, able to be disruptive in the marketplace. These are things that are going to carry the day with an overall value proposition. Growth prospects tied to customer revenue is very compelling. When you have customers that are buying your widget and they also may need your mousetrap and you're providing both of those, you can see how both of those products, and I'm sorry for the simplicity of it, but I think you're getting the gist. This is how you have you have customers now adopting multiple products. And so you want to be thinking about growth through customer validation and customer growth. OPM is attracted to growth potential, customer revenue, experienced, capable, and knowledgeable management teams that have realistic timelines for exit. So kind of remember that too, right? No investor wants to be with you forever. They want to be in, and they want to be out, and they want to move on to the next one. And the next one could be you if you've done a really great job of giving them a great exit on the investment that they laid in you in the first place. Okay, avoid investors who don't lead. Okay, so this is a kind of a little bit of a tricky subject. I'm not saying that these folks are not wonderful people, and they are. I think you have a certain levels of people that are just real risk takers, and others that would like to see, which way the wind is blowing, and they might want to get into the jet stream if it's going a certain way with you. So investors who are looking for others to lead can tell you a number of things. First, it doesn't make their funding any more attractive or unattractive. It does require more work for them to be involved. Secondly, it doesn't mean that they are sold on your investment, but does say that they can be persuaded by others. And lastly, I think talking to investors about others who may be expressing an interest in you but are unwilling to lead is not going to generally positively reflect on your efforts. Pursuing investor groups who won't lead might be worth it, and it might not be. It's kind of a decision that you have to take. I can tell you that when you're talking to investment groups who won't lead, many other investors will say, well, why aren't they investing? It can be a little bit of a climb. So plan your burn and stay close to it. And I think everybody knows what burn is. It's your monthly payout, your monthly expenses, and it's kind of how you watch your cash go out the door. Burn is how fast your company is actually spending the investment, or I like to say, it's how much you're bleeding. All right, so burn signals to investors, what does that really mean? It really means that they're gauging how to protect their level of investment with new money. They know when you're burning through money that at some point you're going to run out of money and you're going to need more, and they're going to be interested in protecting their earlier investment, which is a good thing, except if they don't see the progress you're making, you're not going to get that follow-on. Burn to management is about spending. It's more, management's worried about spending and not from the investment angle. And it's less about concerns for investors as to when another round comes. Unfortunately, early management teams don't really pan out or try to time investment infusions. Like when I go back to my first slide about how big the plane is, that's how much runway you need. So there's seed investments, there's follow-on seed investments, there's larger Series A, there's Series B, Series C. So that's sort of how you extend your runway. So you really have to know as an early management person, this is not necessarily about how you're managing expenses. People that are investors are watching to see when they may need to come in and cover themselves or protect themselves, or whether what you're doing is adding tremendous value and they want to jump on that train. In some cases, actually most cases, if you're burned through your money, that's not a good sign. So stick to the burn that you earned with the investment, what you told people that you're going to spend each month, and what you're going to spend it on. Usually use of proceeds are very important. So there's no stronger signal to investors of your management prowess than spending according to your plans that's adding value that the investors were anticipating. No one has a problem with burn if you're adding value and you're getting closer and closer and closer with your prototype to a real marketable product. And also remember, investors are not unreasonable people. They understand when circumstances are going wrong. If burn needs to be adjusted, inform them. Tell them why you need to make adjustments. This is just simply good investor management. And let me tell you too, as an attorney, I think, when people are left in the dark, that's when miscommunication, misinformation, disinformation, and all the other aspects of it abound, and you end up finding that you bought yourself a problem. All right, so let's talk about that a little bit. Know thy investor, right? Manage them well is really the key. So know who they are and know really what is going to give them a good comfort level. And I think you'll find out you can avoid a considerable number of headaches. So I really want you to think about this a lot. This is a really important slide because investors can be your worst nightmare as well. Investors, they've risked their capital in you, and it was not a gift, and they are not your long lost uncle. They have the ROI expectations we talked about. When you're talking to investors, the single best thing you can do with an investor and managing them, whether they're potential or they're in, is under promise and over deliver. Don't let them have expectations that are unrealistic, and then deliver on your promises that wow them. And then you will find they will be behind you rock solid 100%. This seems to work for business people or sales people when they under promise and over deliver. And really, you're not much more different than that. You're really selling your company's prospects for an investor's dollar. I can't tell you any more strongly to keep them informed. You do not have to tell them where the coffee mate is for the coffee, but I do think you ought to tell them when there are significant events, that might change the trajectory of the company. They're not unreasonable people, but they can become unreasonable, and rightly so, when they're left in the dark about significant developments. That's where misrepresentation claims and fraud claims can abound. And I'm sorry to put my ugly legal hat on, but it happens more often than you know. Inform them, but don't let them run your company. So you're going to have to iterate to the right level of information / control, because they're definitely going to want to assert control when they become your partner. Okay, so there is something we call hidden costs of money, so I want you to watch out for that. So return is not only about the cost of money and alternatives. There are ways to de-risk the investment or lessen the risk. Board seats and management implants can be some of those mechanisms. And the reason they're a cost, kind of an indirect cost, is those board members or management consultants that are placed on your management team can maybe directly or indirectly divert your plans for the company's growth, or worse yet, for the trajectory of the company, kind of taking a whole new direction. I worked on a company, we were making antibiotics, and I left the company because they thought they could make cancer products, or they had a cure for cancer. I wasn't sold that we were the only company that could do that. I thought there were a number of companies that were already doing that, many of much larger than we. I thought that the trajectory of the company had taken a whole different turn. I left the company, and sadly, the company went bankrupt about another 9 months later. So I'm going to talk to you a little bit too about what's called an MFN clause. That's called a most favored nation. I know that's kind of trite, but it kind of works that way, because really what it is you're bestowing upon the earlier investors the right to protect their investments through further money or expertise. So when the first investors come in, they're going to be worried about the next round. And you're thinking, Ken, why would they worry about the next round? Because we haven't even spent this round. Believe me, they'll be watching everything you spend. So they're going to be watching when your burn starts to increase, and then the money is going out the door. Then you're going to find out you don't have enough reserves, and you'll be going back to them. They're not going to invest in the first time around if they don't have a second time around that they can invest at a lower valuation and protect their position. I mean, it's just like doubling down in the stock market. You buy Apple today at $100 and you get 50 shares. Tomorrow you could buy it at $80 and maybe you get 60 shares. So that's really lessening the amount, the overall dollar value, and they play that game even at that level. But they also play that game because they don't want to let out a good thing if they can help it. So there does exist a danger that these people on the board and the management team, that they're influencers, and they can get on that board and influence other people. And this might significantly divert your plans and your strategies. I'm not saying, folks, that you need to have yes people on the board. I am saying you need to be cognizant of how the board is interacting with each other, where sort of people align with each other relative to financing, and be cognizant, or at least anticipate, that this could be an issue. Okay, I tried to give you what is a little bit of an optimal financing plan. Let's talk real quickly about that. You need a compelling overall value proposition if you're going to raise other people's money. Please be reasonable in your targets, valuation, expenses. As I told you before, somebody walks into my office, says I have a startup and it's worth 20 million. I'll say good luck with that. Product opportunity, sell growth potential. Employ significant value add events within your efforts to raise. Tell them we're going to spend $1 million to improve the widget's features. We're going to spend $1 million to make sure the widget is very customer friendly or ergonomically friendly, etc. Things like that. This way, investors, they have an idea whether you're on target with delivering their ROI, and whether that investment may, worse yet, not meet their expectations. The 3S, founder, family, and friends. I think you might hear something. You can read about that stuff. I look at that as that's skin in the game. If you don't have something to lose and you have nothing to lose, I would never be in that boat with you. So you need to see that the three Fs have something to lose. I think most investors think dilution is anticipated, so you don't have to be cute about that. You don't have to be coy. They know that this may not be the only money that are in there, so they should have an opportunity to protect their positions, and that's good management. But that's also smart on your part because now you have the possibility for follow-on. And I think this is just really good sound investor management. And remember, it's really about show and tell. The more you can show and the more it tells, the more money you're going to raise. I can tell you in my opening remarks, or at least in my bio, we raised a significant amount of money for an antibiotic. And that antibiotic, we were able to demonstrate under electronic microscope that the bugs that we were trying to kill would fall upon the material and die. We did that, and I tell you what, the wallet's opened, believe me. We were demonstrating and showing how the activity of the antibiotic actually worked. All right, so I have multiple plans. What I want to leave with you here is certainly be candid with investors. Don't embellish, under promise and over deliver, as we've talked. One size does not fit all. A $100,000 investment needs to be treated differently than $1 million. Options work well with investors. Placement memorandums, you're getting down to the nitty gritty, but keeping an offering document handy that has a lot of flexibility will work. That won't scare away the 25 grand, and it'll certainly keep the 2 million in play. And sometimes, you place 2 million in securities in $25,000 units, so everybody can actually participate. So you get 10 or 12 people to absorb the raise. And lastly, try not to think about multiple raises, right? When people say, it's kind of a loaded question when an investor says, so how much money, how many raises are you planning? Well, I'm planning on having 3 or 4. You're never going to get that investor dollar because they're sitting there going, I'm going to get crushed and crammed up. I'm going to get crushed. So think more about what you need to raise to get to profitability. It works so much better for you, okay? And with that, sorry that took a little bit longer than I thought, but I'm ready for questions.
Thank you, Ken. So we have some questions lined up. We have about 10 minutes to do Q&A, so we'll try to get through as many as we can this afternoon. So here's the first one. Glenn and Ken sound like a great resource as SDOs for new startups. I think I can be helpful too. How do I join NSA2's SDO team? Glenn, do you want to take this?
Sure. So in the webinar, there's contact information. Get in touch with us, and then we'll start the process for you. Yep. You can email us at the address shown there on the lower left-hand side.
Our next question is, do you have any thoughts on the idea of shared financing for shared risk projects among multiple small startups? I'm in a country where we have many tiny new startups that quickly die off, so there are strategic reasons to build a consortium alliances of about 2 to 4 startups to achieve a critical mass.
Yeah, I think I can address that one. So it's really about ownership, sort of what are they buying into? If they're buying into a collection of companies and hoping that 1 out of the 4 makes it or 2 out of the 4 makes it, I think that's a question of what you tell the investor and what the investor gets as an exit. I think that could be somewhat complicated. It's a better arrangement probably that's cleaner is for each of them to have these alliance agreements or to have some sort of a collaboration agreement between them so that they can share information or share resources, share money, share people, and then the investors have a better, clearer sense of what they would be buying. Okay.
Yeah, let's go to the next one.
All right, here's our next one. What happened to the rule of thumb? Ask for more than you need.
Yeah, I think that's a great question, and the reason why you don't ask for more than when you need, that you don't look plausible and you don't look credible. So, try that with a car dealer when you walk in to try to buy a Mercedes-Benz that's in the $55,000 range, and you tell them, look, I'd like to give you 30 grand for it. When can we do the deal? If you cannot put if you cannot put the financial numbers in place to support the larger request, remember, these investors turn these over to their CPAs and their investment advisors, and they'll tear it apart. So that's why being more reasonable about it and being more close to what you actually need to get to be profitable is probably overall better approach. I'm not suggesting you can't say I need 2 million when one will do. I am saying that when you ask for 2 million and your plan does not support a $2 million plan, you'll run into problems.
Yeah, from the corporate perspective, I totally agree with that. They're pretty sophisticated at knowing what's reasonable and what's not. And it goes back to what you were saying about trust. I've seen more deals fail, I think, because the management did not convince the investors that they were trustworthy.
All right, are we ready for the next one? Sorry. Go ahead, Glenn.
Yeah.
Oh, okay.
No, take this
our
one.
our next question is, I work in a university TTO and would like to submit technologies for consideration for startup development. How do I do that?
Rhea, why don't you take that one?
Yeah, so we're gonna open submissions in, later this year in a few weeks. So right now, what you need to do if you're interested in submitting technologies, if you're a university, a researcher, or a startup, just email us at startupdevelopment@nset2.org. What we'll do is we'll send you a sample of the application form so you can prepare the materials, and so as soon as we open the applications, you're ready with the information. Universities can submit up to 10 IP, and you can submit your startups as well. But if you want to have a call with us to know more about the startup development program and how it progresses after you submit, just email us at that email, and we'll set up a call with you as well.
Sounds good. Let's do the next one.
All right, the next one is, how much equity is reasonable for a startup to give up to an investor or financer?
This is Ken. I'll take that one. I think it just depends on what your purposes are for the first round. And from a startup perspective, without a lot of customer input or any customer adoption, otherwise known as revenue, I don't think you can command very much. So if you're looking at raising $1 million for a company that might be worth more than $2 or $3 million, you're looking at least a third or 50% of the equity to go out. That's going to sound harsh. You're going to think, I'll lose control. You don't have to lose control, but you do have to be reasonable, and you do need to tie the investment amount of the raise to what you're going to do with the proceeds. And generally, you have product development plans, you have management team you need to keep in place, you have operations. So you need to make some projections relative to what you think you're going to need over the course of 2 or 3 year period of time where you hope you can reach profitability. So it isn't there isn't any kind of magical percentage to let out. There's no magical valuation. I can tell you that you're going to meet a lot of headwinds if you think with no revenue and you have a promising technology with a medium-sized market. If you value yourself at $5 million, you're way overvalued. A lot of people will tell you I have friends in the investment community that are in very large groups that are telling them when they see $2 or $3 million valuations and people looking to let out maybe 10 or 20% of the company, they laugh at it. They just don't see that. So I know that's harsh, and I know that's from their perspective, but you can push back on that. So the amount that you're going to release should be tied to, or the amount that you're going to raise should be tied to what you anticipate you're going to need. And need to get to profitability, not need to get to the next round.
All right, thank you, Ken. I think we have time for one more question. Let's see how this goes. What is your advice regarding finding an investor willing to invest on a project basis for a new technology solution to a global problem? The revenues from the alpha project feed into the beta, etc.
Okay, so I guess you're looking at a global market, which is can be very challenging, and I'm not sure sort of what the new technology solution is. So you have to look at the actual market, who is your target customer, and I think when you find your target, the whole world is a customer, and then you have targeted market customers, and then you have targeted serviceable customers, the people that are actually going to pay. I think you need to discover like who those folks are, and that's a lot of market research. And alongside that market research should give you an indication through some of the angel groups that may be on Angel List and others that might say who their orientation is. We didn't talk much about this during the presentation because it was really about pitfalls, but understanding your investor and their investment focus is very important too, because they very rarely sort of diverge from that. And so knowing more about who you're going to serve, who's actually going to consume the product around the world as suggested, that's going to give you a lead as to who may have the investment interest, and then that's who you begin your approach to. And so it's just like a wide net, trying to catch all kind of fish, and you might catch fish that you didn't intend. But if you're looking for the tuna, you got to kind of cast it into the ocean, and you might get a mackerel and you might get a shark. But basically, you have to refine who might be invested in the area of solution that you're trying to provide. I hope that was helpful. I know that was very vague, but
I can
that's how I
do
feel about it.
that just a little bit. I would take a look at NASA's TRLs, or what NCET2 has as far as CRLs or commercialization readiness.
Exactly.
And just to speak a little bit to it, if you're in an early stage technology development, you're looking for oftentimes a works-like prototype. Doesn't have to be pretty, just has to show functionality. You're just trying to retire the really big risks there. And then if you get a works-like prototype, then you can start to test that, the performance of that, and sort of, test situations that are meaningful to investors. Moving beyond that, you can start to test it in operating environments with investors. And as you move down that continuum towards something that looks more product-like through defined milestones, then you can start to really make the case for investment. But I think the key there is defining what it is you're going to deliver for the amount of investment you're going to employ, and trying to use public money early on, such as SBIR resources, will help you move that through. So, again, trust, definition, and delivering on what you say you're going to deliver on are really important.
All right. Thank you very much, Ken, and thank you, Glenn. I think that's all the time we have on today's webinar. So thank you both for joining us this afternoon and sharing with us your knowledge and experience about the topic today. And I'd like to thank the audience for joining us as well. Thank you for spending an hour of your afternoon with us. If you're interested again in engaging with NCET2 and the startup development officers, just send us an email at startupdevelopment@ncet2.org, and we'll engage with you either by sending you the application forms if you're a university, if you're interested to become an SDO. We'll set up a call with you after we receive your email. Okay, so thank you again, everyone, for joining us. Thank you, Glenn, and thank you, Ken, and have a good afternoon.
You're welcome. Good afternoon, everyone.
Good afternoon, everybody. Thanks.